Welcome to Griffonomics.
Hey, great to be here.
Imagine signing these multi-billion-dollar deals, right? Like contracts with Amazon and Meta to power the entire artificial intelligence revolution.
All right, basically locking in your future.
Exactly, locking in your future as this visionary tech enabler. But then, almost overnight, you just watch your stock price instantly plunge 14%.
Yeah, it's a massive hit, a total valuation reset.
It is, and it's this bizarre, completely counterintuitive reality that's facing Vistra Core right now.
Well, the market reaction, it seems entirely backward on the surface, you know? I mean, you announce these generation-defining contracts with the most cash-rich companies on Earth. Investors just hit the sell button.
Right. So we are taking you, the listener, on a custom-tailored deep dive today to figure out exactly why that happened.
It's a complex situation.
Very. We are looking at Vistra ticker symbol VST and their massive attempt to transform from a traditional power generator into this new concept of synthetic infrastructure.
Which is a huge pivot.
Oh, absolutely. And to figure out what went wrong, we have a towering stack of sources for you today. We are pulling directly from Vistra's Q1 2026 financial filings.
So that includes the 10K and the 10Q.
Yep, the 10K, the 10Q, their May 2026 earnings call transcripts, and we also have some highly granular forensic analyst reports.
And, you know, the central tension we are unpacking here is whether Vistra is actually a visionary company successfully powering the future of AI, or
if they're in trouble.
yeah, or if they are dragging this multi-billion-dollar legacy utility anchor that is basically about to pull them under.
So to understand why the stock just cratered, I think we need to first understand the massive hype that pumped it up in the first place, right? You mentioned synthetic infrastructure.
Right.
What was the actual bull case here? Like, why were people so excited?
Well, the hype was built on some truly staggering numbers, honestly, and a fundamental shift in how Vistra sells power. According to the filings, Vistra managed to lock roughly 3,800 megawatts of carbon-free nuclear capacity into these 20-year power purchase agreements.
Wow. 20 years.
20 years. We call them PPAs.
Yeah.
And we are talking about a 1,200 megawatt deal with Amazon's AWS.
Huge.
And an even more massive 2,609 megawatt deal with Meta.
Okay, let's unpack this. Because in the traditional utility world, you're pretty much at the mercy of the spot market, right?
Absolutely. It's totally day-to-day.
Right. You generate power, you sell it, and whatever the commodity price is that day dictates your revenue. Like 1 month prices are sky high, the next they plummet. So how do these new deals with Amazon and Meta change that dynamic?
Well, the tech giants building out AI, they're fundamentally altering the power market because they're demanding absolute certainty.
They don't want surprises.
Exactly. So by signing these 20-year contracts with creditworthy companies like Amazon and Meta, Vistra effectively floor-priced their nuclear fleet.
Floor-priced, meaning they know the minimum they're getting paid.
Right. They completely replaced that unpredictable daily market volatility with highly predictable infrastructure-like cash flows.
It sounds kind of like taking a giant apartment building off the short-term Airbnb market.
Oh, that's a good way to put it.
Like on Airbnb, you might make a killing on a holiday weekend, right? But you might sit empty for the next month. It's stressful and unpredictable. So instead, you just take that whole building and rent it directly to a massive corporation on an ironclad 20-year corporate lease.
That analogy captures the exact financial trade-off at play here. You basically surrender the potential windfalls of a tight market to guarantee absolute bankable stability.
And Wall Street loves stability.
They do. The financial markets initially loved this. I mean, the promise of this predictable cash flow was so robust that it actually earned Vistra an investment-grade credit rating upgrade.
Oh, wow, really?
Yeah, they got a BBB from both S&P and Fitch.
Which isn't just, a nice gold star on their homework. I was reading through the forensic reports, and they mentioned this rating triggered something called fall-away provisions.
Yes, exactly.
Can you explain what that means mechanically for Vistra? Because they have a massive debt load, right? Like $19.2 billion.
Yeah, let's break down how credit ratings actually impact physical reality for a company. Before the upgrade, Vistra's massive debt was secured by liens on their actual physical assets.
Okay, so like a mortgage.
Think of it exactly like a mortgage on a house. The bank technically has a claim on your property if you don't pay. But achieving that BBB rating automatically triggered those fall-away provisions, meaning those liens were officially released.
So Vistra basically got its collateral back.
Precisely. They got it back.
So they essentially own their house free and clear again, at least in the eyes of the lenders.
Right, and the mechanical advantage of having your collateral back is that it drastically enhances your financial flexibility. You can suddenly borrow money at significantly cheaper unsecured interest rates.
Which saves a ton of money.
Exactly. Lower interest payments mean more cash stays in the company's pocket, which provides the breathing room they desperately need to hit their stated target. They have this goal of generating $10 billion in cash across 2026 and 2027.
10 billion. Okay, so the corporate lease strategy worked perfectly. The cash flow is locked, the debt is cheaper, they have a clear path to $10 billion. If the core business is suddenly so incredibly stable, why did the market just punish them with a 14% drop?
Well, the crisis isn't about the 20-year timeline of the deals. It's actually about the physical delivery method.
What do you mean?
The original strategy relied on what's called easy colocation. Vistra planned to simply plug these massive new data centers directly into their existing nuclear plants.
Oh, meaning they were going behind the meter.
Exactly, behind the meter.
So bypassing the public power grid entirely so they wouldn't have to wait years in line for interconnection approvals.
Speed to market and low cost. Those were the twin pillars of the strategy. But that specific delivery mechanism has just collided head-on with a new regulatory wall.
Uh-oh.
Yeah, coming from the Trump administration's National Energy Dominance Council, or the NEDC. They've just enacted their Ratepayer Protection Pledge.
And right here, let's just make something explicitly clear to you, the listener. We are not here to endorse or criticize the current administration's policies, or any political policies for that matter.
No, not at all.
Our job in this deep dive is simply to impartially report the factual regulatory environment that is dictating Vistra's market reality right now.
Right, and the regulatory reality here is a fundamental shift in the rules. The NEDC's mandate to these tech hyperscalers is absolute. Their stance is, if AI wants the power, AI must build the power.
So they can't just take what's already there.
Correct. The administration, alongside the PJM market monitor, is intervening to prohibit tech giants from simply siphoning off existing cheap nuclear baseload power.
I have to admit, I don't entirely get the government's angle here. I mean, why does the market monitor care if Meta buys power directly from Vistra at an existing plant? It's Vistra's plant.
What's fascinating here is how it impacts the rest of the grid. Nuclear provides cheap, reliable base power that runs 24/7.
Right.
And that keeps prices low for everyone. If a data center suddenly hoovers up all that cheap power behind the meter, the public grid loses that baseline.
Oh, I see.
Yeah, so to keep the lights on for residential neighborhoods, the grid operators have to spin up much more expensive natural gas peaker plants to make up the difference.
Which raises everyone's electric bill.
Exactly. The PJM monitor views this as tech giants basically shifting the cost of grid maintenance and infrastructure upgrades onto everyday citizens.
Basically saying, you can't just hog the cheap stuff and leave the public to pay the premium. But wait, I have to push back here.
Go for it.
The administration is demanding that these data centers hook up to new power sources and pay for 100% of the associated infrastructure upgrades themselves.
Yes.
If Vistra and these hyperscalers are suddenly forced to pay for entirely new grid infrastructure, doesn't that completely obliterate the math of these deals? I mean, the analyst report cited a projected mid-teens internal rate of return and IRR on those Meta and Amazon contracts.
The intervention is a massive existential threat to that IRR. Yes. Internal rate of return is essentially the annualized profit they expected over the life of the deal.
Right.
Without the ability to bypass the grid quickly and cheaply, the whole colocation thesis just shatters. The hyperscalers are now facing massive capital expenditures to build infrastructure and years of delays waiting for public grid interconnection approvals.
So that's why the stock tanked.
Exactly. The market dumped Vistra's stock because the era of cheap, instant nuclear colocation is officially dead.
Wow. But if you're looking at their Q1 earnings, though, you might be really confused by the stock drop because the headline number is a massive $5.64 billion revenue beat.
It looks incredible on paper.
Right. You see a beat like that and you think the market is crazy for selling off. But if we dig into the forensic footnotes, there are huge cracks showing up in Vistra's legacy utility business.
The headline revenue beat is honestly a lesson in how accounting metrics can totally mask underlying operational reality. Well, the analyst reports flagged that the $5.64 billion figure was heavily distorted by a $723 million unrealized hedging gain.
Okay, let's break that down for the listener. What mechanically is an unrealized hedging gain and why does it matter?
It's essentially a mark-to-market paper profit.
A paper profit. Okay.
Imagine your house suddenly goes up in value by 20% on Zillow.
I wish.
Right. On paper, your net worth just jumped. But until you actually sell the house, you don't have that cash. You can't use a Zestimate to buy groceries.
That makes total sense.
So Vistra's hedges, their forward contracts on power prices, increased in value on paper, creating an accounting shield that boosted their reported revenue.
But it isn't spendable cash they can actually use right now to build power plants.
Exactly.
And they really need that accounting shield because the actual cash-generating part of their business took a massive hit.
Yeah, if you strip away the paper games and look at Vistra's legacy Texas retail segment, the operational numbers are grim.
How bad are we talking?
Their adjusted EBITDA in that segment suffered a 63% collapse, falling to just $68 million.
63%. That's huge. And just to clarify for everyone, adjusted EBITDA is earnings before interest, taxes, depreciation, and amortization.
Right.
It's basically the raw cash the business generates from its day-to-day operations before the accountants get involved to make things look pretty. So their raw cash generation plummeted. Why did that happen?
The culprit was a record mild winter in ERCOT, which is the Texas grid.
Just the weather.
Just the weather. When the weather is mild, people don't run their heaters, power demand drops, wholesale prices fall, and retail margins simply collapse.
Wow.
It perfectly highlights the inherent vulnerability of relying on a traditional retail utility business.
Here's where it gets really interesting, though. The analysts note that Vistra management isn't actually panicking about this drop entirely because of their hedging strategy.
Yeah, they planned for this.
I want to test an analogy here. I was thinking about their 98% hedge ratio for 2026. It feels kind of like buying an incredibly strict insurance policy.
Okay, go on.
You are fully protected when things go wrong, like a mild winter. But there's a major catch when things go right.
If we connect this to the bigger picture, the mechanics of that insurance policy explain their entire financial posture right now. By hedging 98% of their expected generation for 2026, they have pre-sold almost all of their power at a fixed price.
Pre-sold it, so they know exactly what's coming in.
Yes. They did this to lock in that baseline cash flow needed for their $10 billion goal. But the downside of that strict insurance is that if a brutal summer heat wave hits Texas and power prices absolutely spike to, say, $5,000 a megawatt hour.
Which happens in Texas.
It does. But Vistra doesn't get to participate in that gold rush.
But their winnings are strictly capped. They already sold the power months ago for pennies compared to the spike.
Exactly. They have inherently forfeited their upside, but management is voluntarily accepting that papped upside because they require absolute certainty to fund their transformation.
They want to be boring.
They do. They are no longer trying to be weather trading cowboys maximizing spot prices. They are trying to be stable infrastructure builders.
Okay, so let's follow the logic here. The government won't let them hook up existing nuclear plants directly to data centers.
Right.
Their retail side is vulnerable to weather, and their upside is capped by their own hedges. If the government is now mandating that companies like Meta must build brand new power if they want it, why do they need Vistra at all?
That's the billion-dollar question.
I mean, Mark Zuckerberg and Jeff Bezos have practically infinite capital. Why don't they just buy a massive field in Texas and build their own power plant from scratch?
Because of time. Seeding and permitting a greenfield project, which means building from scratch in an empty field, takes a decade or more.
A decade, just for the permits.
Easily. You have to acquire the land, run environmental impact studies, build the transmission lines, and then wait years in the grid interconnection queue. Vistra has a massive, insurmountable moat here, existing real estate.
So they are pivoting from the blocked colocation strategy to what they call captive generation.
Right. Vistra owns over 70 legacy power plant sites and hundreds of thousands of acres of land. Management has explicitly stated they are technology agnostic.
Meaning they don't care how the power is made as long as they can sell it.
Exactly. If the hyperscalers are mandated to procure new captive power, Vistra is raising its hand to build it. They're offering bridge power solutions, utilizing their existing real estate, which already has the golden ticket.
The interconnection rights.
Yes. Existing interconnection rights to the grid.
The sources mention a massive development pipeline of 4,500 megawatts of organic opportunities. What kind of power are they actually building to act as this bridge?
They are leaning heavily into natural gas. The strategy involves taking retiring legacy coal-fired plants and repowering them into modern natural gas facilities.
Oh, that makes sense. Converting the old sites.
The filings specifically highlight the Coleto Creek 650 megawatt plant and the Miami Fort 1,020 megawatt plant as prime candidates for these coal-to-gas conversions.
And they didn't just stop at their organic pipeline, right? I mean, they just dropped $4.7 billion to acquire Cogentrix Energy.
Right, and the Cogentrix acquisition is a strategic masterstroke for this specific pivot. It immediately adds 5,500 megawatts of existing modern natural gas capacity to Vistra's portfolio.
Instantly?
Instantly, it acts as a massive strategic backstop of dispatchable firming power.
And dispatchable meaning they can turn it on and off with a dial, unlike a solar field where you were basically just waiting on the sun to shine.
Right, exactly.
It stabilizes the grid when renewable sources dip.
That existing dispatchable capacity, combined with their redevelopment sites, gives Vistra a speed and cost advantage that hyperscalers simply cannot replicate on their own, not without a 10-year head start.
Okay, natural gas makes sense as a bridge for the immediate future, but that brings us to a massive question mark regarding their long-term capacity plans.
Nuclear deal.
Yeah, Meta didn't sign a deal for natural gas. They signed a deal requiring Vistra to deliver carbon-free nuclear energy. How are they going to fulfill those specific promises if the original plans can't just be plugged into the data centers?
The fulfillment of the Meta deal relies on something called nuclear uprates. And this introduces severe hidden financial risk in the form of a capital lag.
A capital lag.
Yeah. The contract requires the construction of 433 megawatts of new nuclear uprate capacity across Vistra's PJM plants.
Let's define that for the listener. What exactly goes into a nuclear uprate? Are they like building a whole new cooling tower?
No. An uprate is essentially upgrading the internal plumbing and engineering of an existing nuclear reactor so it can run hotter and generate more megawatts out of the exact same physical footprint.
Oh, interesting.
You are swapping out turbines, pumps, and heat exchangers to squeeze more juice from the exact same asset.
Well, squeezing more juice sounds efficient, but I'm looking at the timeline in these forensic reports, and it looks like a financial black hole for the next decade.
It is a massive upfront cost.
Vistra has to start incurring massive capital expenditures for these uprate parts and all the engineering studies starting in 2026. But full capacity deliveries, like the point where they actually start getting fully paid by Meta for that new power, won't arrive until year-end 2034.
This raises an important question, right? Because that is the very definition of a capital lag. They are floating the costs for nearly a decade before realizing the full payoff.
8 years of just spending.
And furthermore, less than 20% of the aggregate uprate spend is projected to occur before 2028. The bulk of the financial pain is heavily backloaded into the 2030s.
This raises a massive red flag for you, the listener, to consider. What happens if Vistra commits billions of dollars over the next 8 years, but regulatory red tape delays the grid connections entirely?
Which is highly possible.
The forensic reports bring up the Data Act of 2026 and broad regulatory reviews triggered by the Unleashing American Energy Executive Order.
The execution risk here simply cannot be overstated. Vistra explicitly warns in their 10K that these uprates are entirely dependent on complex engineering evaluations and, crucially, regulatory approvals.
And the government moves slowly.
Very slowly. The Data Act introduces stringent environmental and grid safety audits. If those audits drag on, the targeted 2031 initial delivery and 2034 full delivery dates will slide.
Just keep getting pushed back.
Yeah. If you are spending billions while your revenue timeline slips further and further into the future, the capital lag turns into a fatal capital trap. The assets could become financially unviable before they even power on.
Wow. So bringing all these threads together to give the listener a final verdict here, we have the colocation strategy blocked by the government.
Right.
We have paper profits masking a massive retail weakness. We have a gritty pivot to natural gas and a decade-long capital trap waiting in the nuclear pipeline. Is Vistra holding a stranded asset, or are they going to survive this new era?
Well, the consensus from the forensic analysis is that the landscape has permanently shifted. The 2025 nuclear-only scarcity premium, the idea that nuclear was the only viable path forward, is totally gone.
Just evaporated.
It has been heavily diluted by the new administration's broader push for a fossil fuel revival, bringing coal and natural gas right back to the forefront.
And there is a looming competitive threat, right? If hyperscalers are being forced to build their own captive power and natural gas is now the favored bridge, what stops Amazon from eventually just building their own captive gas microgrids and bypassing Vistra altogether?
The threat of hyperscalers vertically integrating is the ultimate existential risk here. However, the financial models suggest Vistra is actually highly likely to survive and remain highly profitable through this transition.
Wait, really? After all that?
Yeah. Specifically, we have to look at their 2027 midpoint opportunity target of $7.4 billion to $7.8 billion in adjusted EBITDA.
So what does this all mean? How does that specific target survive all this colocation chaos?
Because Vistra's management was incredibly conservative with their projections. They strategically excluded any potential earnings from the risky meta PPAs and the pending Cogentrix acquisition from that baseline $10 billion cash generation goal.
Oh, so they didn't even count it.
They didn't count it at all.
Yeah.
They didn't bake the speculative, high-risk colocation revenue into their floor. And, as we discussed with the strict insurance policy, that base is secured by an 89% hedge ratio for 2027.
So the floor is incredibly solid, even if the ceiling is currently tangled up in all this regulatory red tape.
Exactly. To synthesize the outlook here,
Yeah.
the era of cheap, instant colocation is officially over. The government will not allow tech companies to siphon off existing public grid infrastructure.
Period.
Period. But Vistra is exceptionally well positioned to survive as long as they successfully execute this pivot. They must leverage their massive real estate moat to build hyperscaler-funded natural gas bridges while carefully managing that uprate timeline.
It's an incredible corporate evolution to track. We've traced Vistra's journey from the dream of effortless synthetic infrastructure, crashing hard into the reality check of the Ratepayer protection pledge.
Quite the roller coaster.
Truly, we've seen how mark-to-market accounting mirages hide legacy retail vulnerabilities caused by a mild winter, and how they're just gritting their teeth and pivoting to captive natural gas generation to bridge a massive decade-long capital lag.
They are navigating a constantly shifting maze of regulatory interventions, desperately balancing the needs of a legacy utility business with the insatiable power demands of the AI revolution.
It's a tightrope walk without a net, and it leaves you with a final provocative thought to mull over. If tech hyperscalers are essentially being forced by the government to build their own dedicated power infrastructure from scratch, paying for all the generation and the massive transmission upgrades, at what point do companies like Meta and Amazon realize they have the limitless capital to just become their own fully integrated utility companies?
It's a scary thought for the utility sector.
Right. If you are forced to build the grid to power the AI, do you even need traditional power providers like Vistra in the long run, or do they eventually become entirely obsolete? Risk defined. Portfolio protected.